we've always looked at for that value add type asset. So we're not looking for Class A, brand new construction right out of the ground type of product. We're typically looking for 1970s to 1990s garden style apartments, 2 to 3 story type of product. So we'll invest in cities like St. Louis or just outside of St. Louis, Cincinnati, Dayton, Ohio, Wichita, Kansas, those types of markets that have similar Midwestern metrics, socioeconomic statistics, and we really like that the basis is lower. So to get a yield on your investment at 40, 50, 60,000 a unit is much easier than getting it at 100, 150,000 a unit from our perspective.
You've raised over $100 million from limited partners, so of course, I think it goes without saying that you know what you're doing. But I would like to hear, as someone who's in the same business but just different capacity, how you look at your acquisitions, what you're looking for, kind of what your target is currently, or how that's shifted over the years.
Sure, absolutely. So we've always looked at for that value add type asset. So we're not looking for Class A, brand new construction right out of the ground type of product. We're typically looking for 1970s to 1990s garden style apartments, 2 to 3 story type of product. We try to stay away from the mid-rise because once you get to mid and high-rise, the issues that you can start to see from water leaks, roof leaks, pipe bursts, things like that. Obviously, gravity gets involved and goes from top floor to bottom floor, and you have headaches pretty quickly. So we've tried to focus on those undercapitalized, mismanaged type of deals throughout the Midwest. We really like to stay within 20 or so minutes of the major metro. So we'll invest in cities like St. Louis or just outside of St. Louis, Cincinnati, Dayton, Ohio, Wichita, Kansas, those types of markets that have similar Midwestern metrics, socioeconomic statistics, and we really like that the basis is lower. So to get a yield on your investment at 40, 50, 60,000 a unit is much easier than getting it at 100, 150,000 a unit from our perspective. So that's the wheelhouse we've kind of played in, taking those assets that have soft occupancy, softer collections, have deferred maintenance. We specialize in going in, taking those projects and turning them around. Our hold periods are relatively low, under 5 years generally, but you were looking for pretty stringent returns. So when I'm looking at a deal and underwriting a deal, I'm trying to get to a 20% annualized internal rate of return before any fund management fees are taken out. So anywhere from a mid-teens to 20-ish% IRR is what we're looking for, which was a lot easier back in 11, 12, 13 than it is today, but we're still able to find enough to say grace over.
Cycling in and out of deals every 5 or so years, you've been in and out of over 3,000 or close to 3,000 apartments and 7,000 residential lots, correct?
A total of about that, yeah.
Okay.
Around 3,000, around 3,000, give or take, residential lots as well.
And today's holdings would only be Fund 6, and all previous funds would have already been exited, is that correct?
No, so Fund 1, 2, and 3 are closed. All return has gone back to our investors at this point, but 4, 5, and 6 have holdings. So we raised Funds 5 and 6 simultaneously. And the reason being, they have sort of a two-pronged approach to them. Fund 5 has a longer-term perspective, whereas our typical fund, we're in and out of an asset in 2 to 5 years. This fund is a longer-term hold, so we're looking anywhere from 6 to 12 years on an individual asset basis. And the thought process for that fund was to buy into deals that we have stable operating cash flows, that we could reinvest that capital slowly into the improvement of the asset, ride the wave of appreciation and increased NOI over the course of 3-4 years, refinance, distribute on a tax-deferred basis, and continue to own and operate. So we started that fund in 2021, just about the time where interest rates started to spike. So that modus operandi is a little strained at the moment, but we're early on and everything's cyclical. So we'll wait that one out. But yeah, Fund 4, we've returned about 85% of our investors' capital, still have a substantial amount of multifamily assets and some land in that fund. In addition to, we still have somewhere in the 125 million range in leverage buying power between 5 and 6.
Being an owner operator, like when you mention all the states you're in, the assets you own, I can't help but think how difficult it would be on the management side. So if I understand your approach correctly, you're hands-on with the asset management, but you don't do any of the property management. Is that correct?
That's correct. So we third party everything from a property management perspective, but we're micromanagers in terms of the oversight of that process and being on site frequently. So when we first began buying multifamily out of the St. Louis market, I believe our first asset in another state was in Cincinnati, Ohio. Small deal, 77 units. It didn't make sense for me to be flying to Cincinnati on a monthly basis to be making hiring and firing decisions for maintenance folks and managers. A better use of my time is working on acquisition, disposition, and really overseeing the operations of individual assets and the fund itself. So we quickly realized that a small team, myself and Rick at the time, it just didn't make sense to do that on a W-2 basis. So we shifted to a third-party model. We did that when we purchased almost a 400-unit portfolio in the Louisville MSA, just on the Indiana side, Clarksville, New Albany, that market. And we interviewed several property management companies, and one based in Louisville really shine through, and we've used them at most of our assets ever since.
So they'll travel with you?
They will, yeah. We are very good. We have a close relationship in terms of communication, and we're very good about communicating when something's not going to work for the other. Logistically, just because of access to airports, we bought an Oklahoma City deal last July, and it just didn't make logistic sense for them to manage that asset because there were no direct flights. It would take most of a day to get there, another most of a day to get back, and to properly oversee an asset like that where we're really trying to change the economics of the deal, we really need someone who can be there at a moment's notice and really oversee that properly. So we agreed, meeting the minds, that just wasn't right for either party, and that works well for both sides.
It must be a huge advantage to have that type of management partner, because for us, for example, being vertically integrated, we really can't make, the way we're set up, we can't make the 40 to 60 a unit type of deals work for us just because they're so management intensive. They're really hard to operate, and the turnaround is extremely difficult. We buy 90s or newer, you buy 70s to 90s. So would you say if you didn't have that management partner or a similar management partner, you'd have to change your investment strategy?
I think that's fair to say. Yeah, it is a challenge. It's very labor intensive. One thing that's good about our relationship with our management company, I think a lot of management companies don't like owners to communicate directly with on-site staff. They think it muddies the water. But because of the tweaks in the steering wheel that we're making on a weekly basis, we need to have that on-the-ground insight from on-site management, on-site staff, and they're heavily engaged in that process with us. So we communicate on a weekly basis on a conference call with with our regional, all of our individual managers, and we make little tweaks on a weekly basis to rent levels and just small decisions in terms of renovation and finish type and those types of things that just make little tweaks in where the ship's going. And having a good partner like that understands how we operate and is supportive of that operating strategy, it makes all the difference.